Bring that bad boy.
Bring a sexy bag.
Yeah, bring a sexy.
If you had a bag, you kind of.
What's up?
Yes, I was.
He wasn't coming out walking to pavilions in Alway, and like it's got like holes through it. Cut open the morning
Hey, Levi, how's it going? It's a long time no see. I ran. Oh, remember we had, you were supposed to have that death censure a while back?
Yeah.
And then he like hurt his back, so he couldn't come. Yeah, and then he was scheduled for 420.
Okay.
420.
It is.
Special ladies.
I know.
Man, I rushed here.
I was too, and there's a lot of traffic. I couldn't get into the parking garage, so I popped the tire. So I called AAA about halfway through the class.
No, it's okay. I forgot it's hitting him. It's not for me. Not for me.
Sure, it's not.
Just kidding, Jonathan. Beautiful little.
That guy's better when you get yeah. Yeah, that's like a much more about. My phone.
What is my problem? Like, why I feel like
Okay. But still better than That's okay. I did the same thing when I sold that time. Yeah, I had it for like 55 minutes. Like, it's really only worth like 3. Alright. Yeah, it was basically it. Your notes? Yeah, can you just photo and copy it? I'll bring it to you. Or if you photocopy it, oh yeah, if you want to study. Oh, that's fine. Were a lot of people doing that, or? You did that? Or you dropped it? How did you do that? Yeah. Yeah.
You're just sitting next to me every time.
Might be able to blow it up. It's readable.
Yeah, me neither.
That has nothing to do with anything. It's just my eclectic taste in music. That is the Lion King, which is one of my favorite plays, and that's the German version, which I like even better. And just got a real kick out of it. Tonight we're going to do some more insurance, and we're also going to do some of the employee benefit plans. Quickly give you thoughts on that. And my good friend Richard Heller. Richard is a true Renaissance man. He was one of the top partners at KPMG, Los Angeles, international tax, regular tax, any kind of tax, esoteric tax, tax that was so difficult that nobody else in the firm would tackle, Richard would tackle. He is truly a Renaissance guy. He knows something about absolutely everything. He's also a car nut, as I am, and a good friend and everything, and he's going to take on some of the stuff with insurance right off the bat and tell you more about it.
Okay, thank you, Jack. I'm actually here tonight. I'm retired. I've been retired for a number of years, happily, and I'm going to share with you, or I would like to share with you, some aspects of life insurance and life insurance trusts. I'm a fan family trustee. I've been a family trustee for 25 years, and I've made my share of mistakes. And I think it's important that you learn from people like me who have made mistakes, because when you're reading through all the material, Jack, you read about the good things and no one ever reads about bad things that can happen and what you really need to think about. And also, it's the practicality of some of these things. I've known Jack for a good many years, and Jack knows my estate planning lawyer, and I've had the same estate planning lawyer for 40 years. It's a long time. I've had the same estate planning lawyer for 40 years. I've had the same insurance agent for 40 years. So the people who have advised me and my family have been with me a long time, and we've gone through the learning process together. They've made some mistakes, I've made some mistakes, and so I think it's important that you learn from some of the things that we did well and some of the boo-boos that we have made. So how do I get this ball rolling?
You can put up whatever you want here, or just and over here, you go to this guy,
And I don't care, the PowerPoint's fine. Okay, and we can go. Oh, great. Okay. All right. So, I have.
Also, look at all the designations.
I've been in USC for a long time. I was an undergraduate student here. I began in 1964. My wife is a USC grad. My math teacher introduced me to my wife. He was the best man at our wedding. We still speak, so we're all on very good terms. My wife was in one calculus section, and I was in another. And he put the two of us together, and my wife is the real Carnut. But then I joined KPMG. I was in my second year of law school, and I made my entire career with KPMG. I actually went into international tax, and I had the good fortune to be able to vest under the pension program. So after 25 years, I decided to say goodbye, hang it up. I bought a ranch, I bought a boat, and I'm now on the water at least once a week, sometimes 2 days a week. I'm very active with the United States Coast Guard Auxiliary, where I'm a coxswain, which means I'm the captain of a small boat crew, and I do search and rescue. So that's really what I do.
How about the small claims judge?
I sit in Ventura County as a small claims judge, and that's always the hoop. I've been doing that for 7 years and more actively for the last 5 years. So that's my background, and as I mentioned, I'm the trustee of a family trust, actually of 2 family trusts. And I hope Jack handed out some of the material. One is the estate of Eddie Hedrick. Does everyone have this material? Yes?
It was in Blackboard.
It was on Blackboard. And I also handed out a problem set, basic insurance problem set. Does everyone have this?
It was in Blackboard also.
It was also on Blackboard. Now, here's the $64 question. How many of you actually worked through the problem set just for fun? You tried. How many of you are in the insurance business or insurance industry? I have a volunteer, or do I have a victim?
I mean, I work for an insurance company, but
Yes.
I'm in our investment area. I don't do anything with insurance products.
Okay, all right, so we're going to talk about some
Don't
of
be
this.
modest.
Yes.
Well, I'm licensed, but I never sold insurance.
Oh, that's a good excuse.
It's also modest. These two guys are experts.
All right, great. Great.
Call on them.
All right, so we'll talk a little bit about this. What is it all about? As you can see, insurance is about risk shifting and risk distribution. Helvering versus Legurse is a very famous case. It goes back to 1941. It's only famous for the definition of what insurance is. But if you want to know the tax law definition of insurance, this is probably a good case. And by the way, I've got a lot of PowerPoint slides, and if you want a set after class, give me your email, and I will email this whole presentation to you. All right? That way, you don't have to take a lot of notes. You can just listen. We can have fun, and whatever you want, I will email to you. Okay? When I was in law school, I really did not take notes. It was better to listen to what the teacher had to say, because I found that students take too many notes, and you lose a lot because you can't follow the conversation. So I try and make it simple. I'm a big believer in handouts and making things available. Now, why life insurance?
I, on the other hand, took copious notes of everything that was said, and I lost nothing, and I remembered everything.
And you still have your notes,
and I still have my notes.
I still have some of mine, which I type after class. All right, so for those of you in the insurance industry, why do we have insurance? What's it all about? Volunteers.
Well, so at the basic level, the idea is, well, like the first slide said, redistributing risk. So
Yes.
it's a population coming together and basically splitting up risk amongst that population, so that no one person bears too much.
Risk sharing, risk distribution.
I agree.
Okay. All right. How about family protection? That's probably the number one, and it's very interesting that a lot of people are underinsured. A good friend of mine from grammar school died prematurely. He was in his 50s. He had an airplane. He bought an airplane. Jack, no life insurance. 3 college-age students. A wife who would never work, a business. He didn't have any life insurance.
It might not have covered him if he owned a private plane anyway.
He wasn't flying. I mean, he flew periodically. He could have got life insurance. He had a small electronics manufacturing business, and he just put all of his money. He just never thought about what would happen. And a lot of people say, I'm invincible, right? And they never worry about it. Another good idea is funding bequests at death, and sometimes a forced savings account for people who would otherwise blow all of their money, and that's my family, because my 2 siblings are professional spendthrifts. So if I didn't sock money away in life insurance policies for them, they wouldn't have anything. Their whole life, we can cash them out later, but I convinced them to go along with the program, because if I made trust distributions to them, Jack, they would have blown it all. No doubt about it. And so I was forced to be creative, yes.
Yeah, with a lot of our policies now, you can actually roll the life insurance policy into an annuity too.
Yes.
So.
Yes. And that is a very good idea, because I have a sibling, and I probably need to do that. I might even cash out his policies, roll it into a life annuity, because otherwise he's just going to blow it.
Say so, what do you think?
I like consensus. Okay. Special purposes, we know about key man insurance or project insurance. I did a big house remodel, and the contractor to me was older, and I said to myself, if this contractor dies, well, in the middle of my house remodel, I am really stuck. I have a major problem. So I went out, and it was very inexpensive. I bought a policy of 2-year term life insurance to cover the cost of the remodel, most of the cost of the remodel. I think I got a $500,000 policy for 2 years, just in case something happened to my contractor, because I had a lot of money in this house, and he knew where all the nuts and bolts were and what he was doing. And by the way, it was a remodel of a house that had been built in the 1920s, so don't ask me about plans. There were no plans. You know, he would go through the house and knock out a wall and say, oh, here's what we're going to do in this room. And then he would just go through another room and knock out a wall with a chainsaw or a crowbar and say, this is what we're going to do there. He had everything in his head. I had nothing on a piece of paper. I said, Merv, where are the plans? We don't need no stinking plans. I know what I'm doing. That's why I wanted project insurance. Funding buy-sell agreements, very, very common. I'm sure Jack has talked about this. Corporate-owned policies for stock redemptions, partner-owned policies to cover cross-purchase interests, funding charitable gifts. I also have a charitable trust which I have funded with a policy of insurance on my mother's life because she wanted to leave a rather large bequest. I deduct the premiums annually. I found a case that allows you to do that. I've registered the charitable trust with the State Attorney General's office. They have exempted me from annual reports. When I collect on the policy, I make the charitable distributions. It's very easy to do. And my estate planning lawyer approved of it. Traditional life insurance, okay. What do we know about term insurance?
It's cheap.
It's cheap.
It's a fixed premium for a set period of time.
Correct.
Most policies today actually have a conversion, so you can turn that into permanent life insurance if you wanted to.
Yes. And there's no cash value. And the basic idea is that your premium is the probability of death multiplied by the death benefit payable. Can I put this, how can I tweak this and put this?
Just put it right up there.
Put it right here. You're going to turn on the magic lamp.
And then you go here.
Okay, great. Does everyone see this?
You want both? Here. Yeah, both.
Okay, right. So here we have
You can also make this zoom in
Oh.
and out if you want.
wonderful.
So you
All
get
this,
the whole-
all this high-tech stuff USC never had when I was teaching. Okay. We have term, we have whole life are the two most popular. We have endowment. Basically, term is pure insurance. Whole life combines term with a savings account feature. And endowment is basically term insurance for a specified period of time, coupled with a savings account. And here's the idea. Here we have a person who's age 55, and the probability of death when you're 55 years old is less than 1%. And as we age, the probability of death increases. And so the key principle for insurance is mathematical expectation. In the first year, the premium on a $500,000 policy, if you're age 55, is $3,968. Why is that the case? Well, that's simply the probability of death multiplied by $500,000. That's the mathematical expectation. And then it is discounted by 1 year on the assumption that all premiums are paid at the beginning of the year and all death benefits are paid at the end of the year, correct? And so here we have a very simple model of term insurance. If I'm age 55 and I want to buy a 1-year term policy, I'm going to pay, and if the insurance company can earn 4%, right? I'm going to pay $3,815 for pure insurance plus a loading factor. What's the loading factor? Well, the agent gets a commission and there are home office expenses, and so we talk about premium loading. And if I want to buy a policy of insurance that will cover me for 5 years, I go down 5 periods. I have the premiums for the first 5 years discounted, add them up, and that's what I pay at the beginning of the policy, or I can finance it over the term of the policy, correct? We can finance certain term insurance policies. Now, if I'm age 55 and I want to buy a policy that lasts until I'm age 90, I've got 36 years of premium payments. Notice that the probability of death at the age of 90, this is for a male, and this is the government Social Security tables, is only 0.177, 17.7%. My premium is $88,000. If I take the present value of all these premium payments for 36 years is $345,000. That would be the net single premium, correct? That would be the net single premium that I would have to pay for this particular term policy up front, covering me until I'm 90, but I can also finance it over time and pay a net annual or a level premium, can't I? I can.
Coleman? Coltrane, sir.
Yes.
Are you discounting by like 20-year T-bill rates, or?
No, I just have an arbitrary 4% present value factor. It's very interesting that if you go back to the 1920s and you look at an insurance table, an actuarial table, the discount rate used was 3.5%, and 3.5% was used as late as 1958. I have no idea what rates insurance companies are using today. Do you know?
I don't know. I know they do repricing. It's like an industry-wide thing. So up until like 2 or 3 years ago, they were using like 1980 mortality rates. And they
Every
just switched to, like,
insurance
2000.
company has its own staff of actuaries, correct?
Mhm.
Every insurance company has its own life tables, and so they do not use the standard tables. They go by their own experience. And of course, the interest rates can vary. So if we wanted a whole life policy goes to the limit of the mortality table, correct? And it's very expensive because in the last year, the probability of death is what? 1. It's certainty. And so the premium then becomes 1 times the face value of the policy, and that's just discounted back. In fact, I have here's the Social Security actuarial life table for 2006. Does anyone know how long Social Security thinks you will live? 150? Any more guests?
85.
The tables go to 119, and both for men and women, I'm going to show this to Jack so you won't think I'm fooling you. What's the probability of death at 119?
93.9%.
93.9%. So that's why we're in deep doo-doo. We're living a long time. So, the pricing principle, what this illustrates, let's see, how do I turn this off now? Go back to the slide. Okay. The pricing principle is that the present value of the premiums that the insured is required to pay for a specific policy has to be equal to the present value of the policy's expected death benefit. It's very similar to a bank loan. If you borrow $500,000 from a bank and you're going to make periodic loan payments, the present value of those loan payments must equal the present value of what you've just borrowed. Otherwise, the bank would always lose money. The same principle with insurance, but we're dealing with mathematical expectation because we have mortality. So we have a contingency. And as I mentioned, the premiums are loaded to reflect home office charges and expenses. And what does your bank do? Your bank doesn't necessarily charge you the market rate of interest. It adds points onto your loan up front, which is similar to loading to cover bank expenses, right? And also the commission for your banker. So again, mathematical expectation, if a person has a 5% probability of dying within the next 12 months, a 1-year, $100,000 policy would cost $5,000, and death is deemed to occur at the end of the period. The payment is made at the beginning, and so the premium is discounted to reflect the interest that the insurance company will earn on the premium money. And again, what I just showed you, we extend the basic idea. We can take the mathematical expectation over many, many years, and we can go to the end of the mortality table, which according to Social Security is beyond 119, because even at 119, there's only a 93% chance of death. So as you can see, this becomes very expensive to buy whole life insurance, which is why most people buy term insurance. They say whole life goes to the end of the mortality table. The net single premium or the annual premium will be a fortune. I'll just buy term insurance, and I won't need any more insurance beyond age 70. I'll have enough money by then. My family will be protected. I won't worry about it. So it is very common to see people buying insurance covering the ages of probably 30 to 65. Beyond that, it becomes prohibitive in terms of cost. Right? Okay. That's what you see in your practice?
Yeah, we don't really sell whole life
Yes.
anymore. It's almost all universal life or variable universal.
Okay.
Just because of you can pay much more up front and hopefully earn to cover the premiums later in life.
Okay. And I have some universal life, and I've made some boo-boos with universal life, so we'll certainly talk about universal life.
Richard, I've previously told them that there really is no such thing as a single premium payment, because every policy written says this is based upon our assumptions and so on and so forth, and if it turns out to be wrong, you're going to owe more money.
I
And
have
a classic
two.
example is executive life.
Yes, and I had some executive life which was called in. I didn't get burned. I was lucky. My agent said, executive life is about to go bankrupt. You better surrender your policies. And I lost a little bit, but most of my policies were surrendered, and I got my money out. And that was the classic bust in the 1980s. You think insurance companies are all solvent. They aren't. And therefore, one of your missions as an advisor is to make certain you do your due diligence. And what do we look at? We look at the various ratings, correct? AM Best is one. There are several different rating companies. Are you familiar with the Joseph Felt newsletter?
No.
Okay, I'll have more to say about that. Oh, we have your magic message, the one that you love so much.
I have no idea why that came up.
Jeff.
Supposedly a button on the computer that caused it.
Isn't that strange?
I forget
It came up in his office, okay. Last time I had a computer problem, I took my printer, put it on my front lawn, got my shotgun my 12 gauge, my shutter full of holes. It didn't solve the problem, but I was a very happy man. And I put it in the trash and I went out. My wife bought me a new printer. No more Epson printers. I went to HP. But wait till my computer goes bad. Isn't that weird? And that just happened in his office. Fortunately, I can't compare. I'll put these up the old-fashioned way.
I think you click on it.
Okay. Thank you.
Beast.
Okay, great. So anyway, that's the basic idea. It's just all expected value or mathematical expectation. Premium financing, I do have 2 net single premium policies where I paid the premium up front. It was expensive, no more premium payments.
But your policy says that's based on their expectations, and you might have to pay more in the future. Every single policy says that.
Yes.
I don't know if we can actually still do this today, but with some of our higher face value universal life policies, we actually had, it's more for high net worth people that were illiquid. You could actually borrow from a division of AIG called AI Credit.
Yes.
Put like a $20 million face, put $2 million in up front, and exactly like you said, it's based on the assumptions at the time you illustrate the policy. The idea is you make that one single premium, and if you're the agent, you collect a huge commission.
You collect a huge commission. They do exist, but I agree. Whenever you have universal life, you always have to look at the in-force ledger because you may be running out of cash value because the universal life policies are interest sensitive, and I have a graph that shows this, and that's what I want to talk about. The insurance reserve is technically what gives you your cash value. The insurance reserve is a function of the method of financing, because in the early years with the level premium, you're paying more money than you need to pay, and that helps fund the leaner years. So you are building up some cash value, and so the insurance reserve and a policy's cash surrender value is basically a function of the method of financing from an actuarial viewpoint. So cash surrender value, whole life insurance, pure whole life, is basically term insurance to the end of the mortality table. Today, very few whole life policies are being written because no one can afford to go to the end of the mortality table. That's where we have universal life. The policies mature 95, 98, 100, which means they run out of cash value and there's no more death benefit, right? And that's I have some of those policies. So when an insured dies at the end of the mortality table with pure whole life, the insurance company's payout is basically supposed to be the savings fund, and I have a graph. We'll get to that in a minute. Insurance is sometimes marketed as an investment. I don't view it as an investment. I see it as a means of death benefit, family protection. However, to the extent that there is a savings account that you do have cash value buildup, you do have an investment element, and it is possible to determine and quantify your annual rate of return. And there are techniques for doing that. You'll hear a lot of people who will say, don't ever buy whole life, always buy term and invest the difference. That's one school of thought. There's nothing wrong with buying cash value insurance as long as you understand the limitations, you understand the insurance company's projections, you know what the limitations are and the risks. Non-traditional life insurance, here's where we get into problems. Some underwriters offer a policy, offer policies that are contingent upon investment or stock market results, correct? So you may or may not get your death benefit depending upon stock market performance. And I think the term goes by a variable universal life. So the nomenclature varies from company to company, but it's basically a policy that is a function of how well the underlying investment portfolio does. And how do insurance companies make money? Well, they make money on investment performance because they have lots of cash, and they also have mortality gains and mortality losses, correct? I mean, people may die prematurely, but then some people may live much longer too. So when you're looking at an income picture of a major life insurance company, it's investment gains, investment losses, mortality gains, mortality losses. That's it in a nutshell. We also have some policies may allow for flexible premium payments and provide for market interest rates to be credited to the cash value reserve fund. And this is what we call traditional universal life. And again, the interest rate is the key variable. So we have universal life and variable universal life, and there may be other nomenclature that is used within the industry, but basically it's these two kinds of policies. One, the death benefit is a function of stock market performance, or can be. The other allows for flexible premium payments and cash value buildup. It's a function of how well the insurance company does with its underlying investment fixed portfolio. Caution, okay, we talked about traditional whole life is expensive, and non-traditional interest sensitive or investment oriented policies can fail to provide the family protection you need. Question? Yes, sir.
So the only reason why you want to convert term to whole life is because the cash value will increase later on?
If you want a cash value policy, and if your term is running out and you want a cash value policy, you pay for the conversion option, but you can have convertible term, which will enable you to convert to a whole life. You'll have a premium uptick, but then you have a cash value policy. Okay? And all of this is a question of benefit and cost analysis. There's no escaping from present value analysis and looking at the benefits and costs and doing a qualitative analysis of your particular situation.
And Coltrane, the second reason for converting from term to whole life is to stop the insurance agent from calling you every Wednesday morning.
I'm very lucky mine never calls me. Traditional level premium whole life. This is what the graph looks like. In fact, if you buy it young enough, cash value builds. And the whole idea is that if you live to 100 and you die, what is the insurance company writing you a check for? He's really writing you a check for your prior contribution to the fund. You're getting back exactly what you put in. The insurance company is paying you the present value of what you contributed to the fund over your long lifetime. So That's why whole life insurance, actuarially speaking, your whole life is equivalent to decreasing term coupled with an increasing savings fund.
Does the cash value ever equal or exceed the death benefit?
No. No. But at the moment of death, which are, well, yes, it will. In theory, it will with whole life, because if you've got a $1 million death benefit and you die at 100, and this is the limit of the mortality table, if age 100 is the limit of the mortality table, in theory, you have paid in all of those premiums, the present value of which is $1 million.
So if you had a situation where your cash value equals your death benefit, it's better to cash it out than to let it sit as a policy?
Careful. Well, you're losing your death benefit. You can surrender your policy.
But you would get the same amount of money, right?
Less a surrender charge. In theory, you could get
I
close.
don't think so, because what is happening there is it's not just the money that you put in, it's the money plus the investment that they
It's
made.
the investment
and
interest.
that investment is building up on a cash-free or a tax-free basis
So
with
you
the
have to
insurance
have to
company.
pay the tax.
You are not taxed on the increasing investment return that you get in there.
Okay.
So that if you turn it in beforehand, your cost basis may be this, but the cash surrender value may be this, so you
have an
haven't paid
investment
the
gain.
income tax.
Right. And
But
so
if you keep it until death,
Then
there
you get
is
to
no
step up and
income
pay.
tax gain under section 101.
Right, and the only way to cash out prematurely is if you're sick, you have a biannual settlement, and there's a provision in section 101 for people who are elderly and in poor health, and so forth. But your cash value is a function of what you put in plus the investment income that's been credited to your account. So a lot of people say, well, if you live long enough, just buy term insurance because you can invest your own money, put it in the stock market, and you'll be better off. I mean, that's popular folk wisdom, but that's taking a risk of mortality. What if you die prematurely and you haven't really saved enough money? And that's the problem with dying at 40 or 45 or 55 or 60. And I don't want to die before I'm 100 anyway, so as long as I'm in good health. Non-traditional whole life. Here's where we get into the universal life or the variable universal life. We have a death benefit. We're building up cash value, but the return on the cash value is sensitive to the market rate of interest or the underlying performance of the stock market. And so what do you see here? You see that maybe you want to have a policy that carries to age 100, yes, but you run out of cash value at about 90, 92. So when you run out of cash value, what happens? The policy matures, there's no more death benefit unless, Mr. Insurance Agent, I've noticed, I looked at the in-force ledger, and I've noticed that your policy is about to run out of cash value. If you're willing to write a check for a couple $100,000, we can extend the policy for another year. And if you're willing to write a check for maybe $500,000, we'll extend the policy for another 2 or 3 years. Is this plausible?
Mm-hmm.
This is what is now happening with some of these universal life policies where people bought them, and I have some of them, and I didn't really appreciate what would happen to the economy and the lower rates of interest because I took these policies out when interest rates were very high, Jack. So I probably should have cashed out some of the policies when my mother was 80 or 85. I would have had a lot more money. My mother is now 91 and she's still alive. And I have enough cash value to carry my policies to 95 or 96, and I'm thinking about cashing out prematurely. Yes.
As an example, like some of the older policies we have, when they were sold, they were illustrated at like 15 to 18%, through 20 years of the policy. Well, now crediting rates are like 4.5 to 5% on average.
My own agent used, I think 6%. We never went for these wildly outrageous rates, and I'm aware that that happened.
Yeah, I mean, that was back in the 80s when rates were much, much higher. I mean, I think from like 90 on or so, it's been lower. But even so, at a 6 to 7% difference compared to actual current rates now, it's still a huge gap.
So these cash value funds have not performed well. And so now, if you want to extend the policy, it's getting out your checkbook and writing a big check. So this is one of the boo-boos that I made. I probably should have looked at this closer and cashed out when my mother was in her 80s. I would have been ahead of the game. And now, I'm probably gonna break even, or I may even be behind the 8 ball. And I did pay attention to this, and I regularly met with my agent, and we said, well, what's gonna happen with interest rates? Are they gonna go down more? Will they go up? Oh, they've gotta start coming up. The economy, we've got lots of problems with our debt, right? I've been saying interest rates are going to go up. I started saying that 3 years ago. And what are you getting on your money market? Probably nothing.
Yeah.
Okay?
Question?
No. He says he gets 0.6%.
0.6%. That's not enough to make this work, is it?
Not
Hardly.
even
So,
I had a question
yes.
about, so although the cash value fluctuates with the market return, the death benefit always stays the same?
Some policies, the death benefit will vary also. So it's a function of the policy and the underwriter. And this is what lawyers and CPAs need to understand. And those of you who are financial planners and doing this financial planning, a lot of people just ignore the subject of insurance, right? They go to school and they learn the rule that, oh, you know what, when my Aunt Millie dies, I'm going to get $500,000, it's all tax-free. All right, I learned that rule in section 101A1, and I also learned that as long as the policy is not payable to her estate, or it's in a separate insurance trust, or maybe my aunt gave me the policy and I'm the owner, I don't have to worry about any estate tax, right? So we learn the income tax exclusion rule and we learn the estate tax exclusion rule, but we don't learn any of the financial aspects of life insurance, which I think are critical, and that's why I want the warning light to go on, so that at least you remember, there's more to insurance than just what the agent tells you. You really have to study the subject a little bit, learn some basic actuarial principles, look at the policy, understand the underwriter, and understand what you're really buying.
And also, remember what Richard said over here, and that is, while it's true that the policy stays at $1 million or whatever it is, it was supposed to go to $1 million to the age of 100, but at age 92, it's gone, and it becomes zero, unless you put in a lot more money.
The
So
policy
yes,
matures.
Yes, maybe it stays at that $1 million face amount, but it also disappears at 92 instead
Your
of that.
entire death benefit disappears. Yes.
Yes. And she was first.
Okay.
Oh, sorry. I just wanted to make sure that I understood what you were saying. So, your insurance agent calls your insurance agent calls you at 90, and you've got a lot of cash that you want to give to your heirs. So you say yes, I'm going to put $500,000 and extend it to 98 or whatever.
Right. You have to add to the cash value fund because it's been taking a beating.
Okay.
Okay.
So, if you think insurance rates are going to go up in the future, then you want to put in